Talk a little bit about the euro then. We started this programme, we've talked a few times about where the euro goes from here and how leveraged funds are now along the euro. In fact, whilst we chat, I'll bring up the nice chart which Matt's been laughing at me for this morning. What are your expectations around the euro? Set out your stall.
Yeah, so if you look at a currency and you deconstruct it, is what we do now, into three different parts: the structural, the cyclical and the political. Now, when Trump got elected, people were politically optimistic about the US and told me there's this Dutch election, there's this French election, beware. It's exactly flipped around now, right? And the second thing is, from the cyclical side, the Fed's going to raise rates, the US economy is great, Europe's in the doldrums. Actually, it's Europe that's surprising to the upside. And we're talking about the ECB possibly doing something. So you can feel there's been a turnaround from both the cyclical and political side. The structural side at the moment, nobody cares, and we'll leave a little candle burning there just to have it a little bit illuminated. But you can see there's been a complete flip over from this total optimism from the day we had the US election, where everyone was dollar bullish, politically bullish, cyclically bullish. And you sit here today, that's the attitude of Europe and not the United States. That has to reflect changing prices. My end of the year euro target is 120.
OK, 120. There you go, Matt. I found you. This is the euro positioning chart. And here is this is the leveraged funds going long, that very small green bar you can see.
But
just
there, and the trend
corner.
is clear, right?
Yeah.
But what's interesting is you go back to 2014 there, where we start talking taper tantrum and people start talking about the Fed possibly raising rates. So that's, don't forget, 3.5 years ago. I know it's flown past. But let's imagine if it's 3.5 years' time until the ECB actually does something, the euro should be going up now, because the dollar moved in 2014 extremely aggressively. But remember, the other day, the Fed raised rates and the dollar did nothing. It was priced in. So let's start pricing stuff into Europe.
One problem I have, and if you want to pull up a chart, I got another one, 5361
there we
is
go.
a good one.
Thank you.
With the outlook for the ECB actually doing something, it seems to me that Draghi is, you know, his default is dovish. And if you look at the inflation outlook, I mean, it's really nowhere near their target. In fact, they keep lowering their forecast for inflation to so far off of 2%, I have trouble believing they'll ever get there.
Can't you sniff that bearishness that's coming? Can't you sniff the change in the cycle that people are feeling? And just like the Fed, if the ECB don't want to do the tightening, I'll do the tightening for them with euro dollar. So in 2014, the Fed was going like you are, well, kind of if, and we said, right, we buy the dollar, we'll do the tightening for you. And the dollar went rocketing up about 25% on the DXY in 2014, just where you showed. So why not now? If the ECB is 3 years away, the market's got to start smelling the coffee, man. Can you not smell it?
But if you can't get the wage inflation, I mean, the currency market can do a lot, but you just can't raise my salary, right?
But there's no wage inflation in the UK. It doesn't stop the market, 3 people on the MPC voting for a rate hike. There's no wage inflation really in the US. Hasn't stopped them. There's no wage inflation in Australia. There's no wage inflation. And if you don't believe me and you think there is wage inflation, go demand a pay rise from your boss this afternoon and say, if you don't give it to me, I'm going. Well, you just tell me when your leaving party is, because you're living in fear. You think if you ask for a wage rise and you don't get it, you'll never get another job again. So yes, there's very low unemployment rates, but there's no wage inflation, let's face it. But that hasn't stopped people being hawkish on the MPC, being a little hawkish on the Fed, being a bit hawkish in sometimes in Aussie, being a bit hawkish in the Eurozone. There is no wage inflation.
There is no Phillips curve.
The Phillips curve. I've never felt the Phillips curve. No. We've got US bond yields, as you well know, going back down to, on the 10-year, to 1.9%, which doesn't look that outrageous now, but as the year progressed, Steve Major, as you know, has had a very low bond yield forecast, but it's part of this deflationary world we're living in. So yes, there's a cyclical upturn in growth and people get excited about interest rates, but there's no inflation. And
is there a euro strength that's too strong for the ECB that they then kick back at? You're talking about, what did you say, 120 is where you think it goes?
So,
will they think that's too strong and kick back against it? No?
What are they going to do? What are they going to do? Come to my house, knock on the door.
Talk more bearish.
Knock on the door and say, David, please don't have that.
Send you bearish notes, David Bloom at HSBC.
Well, the Fed weren't that happy when some of the dollar kept going in 2014, but what can they do about it? I mean, unless it crushes the cyclical recovery, which I don't think it will. Yes, it could harm it, but I think the euro's going upwards and onwards.
Well, even Angela Merkel said the euro is undervalued, right, because of ECB policy when she was talking to a class of school children.
Yes, and the potato prints they did and the hand prints they did after that were absolutely amazing.
What do you think about Bunds? I mean, yielding 0 spot, or what does Stephen think about Bunds yielding 0 spot 275?
Well, I mean, we're more bullish on treasuries, a little more bearish on the Bunds, so we've got a flip there. But really, it's yields will stay low. You know, all those looking and bet against Steve Majors, you know, a lot of them are buried in my back garden looking for higher yields. I wouldn't go against him. He's been on a blinder for the last 4 years.
Yeah, so we hear. Now, we talked a little bit about the UK in passing, but let's put it into the focus, shall we? This is Bank of England base rates obviously in blue, and annual CPI on the rise, GDP looking sluggish. We talked about the possibility of stagflation in the last hour.
Stagflation? What are you all smoking? Come on!
No?
What are you talking about, stagflation? Have you seen, well, funny, you didn't put the wage numbers up there. Real incomes are getting squeezed. Inflation is rising more than wages. This is sterling working. Now, you have to realize that sterling is the most brilliant thing we've got, because if we were like Greece, it's actually the people that have to suffer. Unemployment rates go up, wages get squeezed, and you become competitive again. In the UK, what happens is sterling falls, inflation rises, real incomes get squeezed because inflation is rising higher than earnings, and consumption slows down, so the current account deficit can get better. This is a healing process we're living through.
So you see the inflation, but not the stagnation part.
Yeah, the inflation is there because sterling has fallen. I mean, you've got to see that it's not, as you say, the Phillips curve and you know, the output gap has been squeezed and the central bank. No, this is inflation has risen because the currency has fallen, because we've got this great big huge current account deficit that we've got to get rid of somehow because we've changed our trading relationship with Europe.
Where do you see the white line on the chart going, I think is what Anna's trying to get at here. And I mean, does that continue to come down, or do you see it trending back up in the event of this fake Brexit that we're set up for?
Okay, so in my world of cyclical, structural and political, the UK is not a cyclical currency. The cyclicality is minor. It's a political and structural currency. The politics is Brexit. The structure is the current account deficit. The rest of it is really noisy. And that's what this currency is about.
And is the politics of Brexit softening, or is that
I hear that it's softening, it's not softening. You know, I heard that the big problem would be France. We found out it's the UK. We heard that it's Greece that would leave the EU. It's the UK. And now we're hearing it's going to hurt, from the last speaker, it's going to hurt the Europeans more than us. Thrice we've been wrong.
We can look for risk in the wrong places, can't we? David, thank you.